up 0.5%, and what boosted us is the resource tech.
Anglo-American, Billiton, Exoro, they're all there. Obviously,
the usual suspects.
The normal suspects. What was interesting is Nedbank's up strongly where the other banks are down. I mean, Standard Bank's the worst of the top 40, down 2%. First Rand's down 1%
Yeah, Nedbank
Standard Bank's up
2.3%.
2.3. Yeah, it's up big. So obviously, there's some people who think that there's more to the takeout than actual rumours. So yeah, we'll see what happens.
What a difference. I mean, Standard Bank at the bottom of the top 40, down 2.3. Nedbank basically almost at the top, up 2.3. Do you think there's going to be a Nedbank takeover? Do you think it's Standard Chartered?
Look, I think all the banks are going to be taken over eventually, because that's just the reality of the world. You can't truly serve South African companies that are globalizing themselves from a domestic base. You have to be tied up. So maybe it's not a takeover like Barclays, maybe it's an association like Standard Bank, but everyone will eventually be tied into a major global player.
So what would your play then be on the financial sector with potential takeovers being imminent?
Look, you must never let a takeover influence your decision to buy or sell a share. If you think a share is cheap, you must buy it. Then if someone else thinks it's cheap and wants to take it over, that's even better for you. But don't buy a share on takeout prospects. You must, if you think it's expensive, don't buy it. We think all the financials are cheap, so we're buying it, and we have got Nedbank, but we got them all because we think we're cheap, not because we think Nedbank's going to be taken
Wayne,
out.
a little earlier we were chatting about whether we're seeing some risk coming to the fore. We know that quantitative easing could potentially come to an end.
Correct.
It really all depends on what we see on the employment front in the US.
Labour and houses.
Would you start selling out of the market just before quantitative easing comes to an end?
Look, it's all dependent on valuation. So the simple answer is the market's now a 15 price earnings ratio. That's not massively expensive. If it goes to 17, well, by the time QE ends, we'll be selling at 17, whether QE is ending or not, because then the market's expensive. So this is a valuation story. You were talking earlier on that this smells of 2007, 2008. It does, except shares are not as expensive as what they were then. So that's the reason not to panic yet. So that's one of the big
differentiating factors.
Yeah, and the key to that phrase is yet. Everything, if things go the way it did last time, share market's going up.
I must say it is an exciting time when you see what gold is doing. Silver hitting new all-time highs that we haven't seen since 1980. Where are you finding value right now, apart from the resource and financial space?
There's value, as I said, there's value in the financial space. Some industrials reflect very good value, we think. We think that Bidvest shows extremely good value. Building and construction shares, there's risk there, but there's also clearly value there. What is expensive are the retailers, and they remain expensive. SAB is expensive, and Richemont's expensive in our view.